Welcome to the Retirement Wealth Podcast. We're excited to have you join us for another insightful episode.
Absolutely, Emily. It's great to be here. Today we're diving into something that can be a bit confusing for many retirees: the taxation of Social Security benefits.
Right, it's such an important topic because, many folks don't realize how their Social Security income can be affected by other income sources they might have.
Exactly. And understanding this can really help in planning your retirement income strategy.
So, what are we going to cover today, David?
We'll break down how Social Security benefits are taxed, the income thresholds that come into play, and how to effectively manage your overall tax situation in retirement.
That sounds super helpful. Plus, we'll touch on some strategies to minimize taxes on your benefits and how that can impact your overall retirement plan.
Yes, and we'll also discuss some common misconceptions about Social Security taxation that can lead to unexpected surprises down the road.
Perfect. It's all about being informed and proactive, right?
Absolutely. The more you know, the better decisions you can make for your financial future.
So let's get started. David, can you explain how Social Security benefits are taxed and what retirees need to keep in mind?
Emily, understanding the taxation of Social Security is becoming more crucial than ever for those nearing retirement or already enjoying their golden years. We're living in a time where inflation is definitely a concern.
Absolutely. And it's not just inflation. There's also market volatility to think about. People are worried about their investments and how that might affect their overall retirement income.
Exactly. Just think about it. If someone's relying heavily on their Social Security benefits and those benefits are taxed, it can really eat into what they receive each month.
Right. And I've heard stories from some retirees who didn't fully realize how much they'd be taxed on their Social Security. They thought, I'll just get my full benefit. But then they were in for a surprise when they filed their taxes.
Yeah, that's a tough pill to swallow. Let's say a couple in their 60s living in Florida planned their retirement around a certain income level. They thought they'd be fine with their Social Security and savings, but when they got their tax returns, they realized they were in a higher tax bracket than expected. They had to adjust their budget, which is never easy.
That's a perfect example. And it's not just about the numbers, right? There's an emotional aspect to this too, knowing that you might have to cut back on discretionary spending or even make tough choices about healthcare costs.
Exactly. Healthcare is a significant expense in retirement, and it's only getting more expensive. When you factor in that some of your Social Security might be taxed, it can lead to a lot of stress for retirees.
So true. And then there's the legacy planning side of things. If someone is trying to leave an inheritance for their kids or grandkids, they need to be mindful of how their income and taxes could affect their estate.
Right, and with all the changes in tax laws and Social Security rules over the years, if you're not on top of this information, you could end up with a much smaller legacy than you intended.
It really makes you think about the bigger picture, like how all these pieces fit together. If you don't have a solid plan, it can really impact your financial security, which, is what everyone hopes to achieve in retirement.
And let's not forget, the current economic landscape is full of uncertainty. With interest rates fluctuating and the market reacting to global events, having a tax-efficient strategy for your Social Security benefits can provide some peace of mind.
For sure. It's like a safety net. If you know how to navigate the tax implications, you can really maximize your benefits and avoid unnecessary stress.
And speaking of stress, I remember working with a client, let's call her Nancy. She was worried sick about how her Social Security would be taxed. She had a modest income from her pension and savings, but she'd been counting on her Social Security as a primary source of income.
What happened?
Well, we worked together to analyze her situation and showed her how managing her assets could lead to a more favorable tax outcome. By adjusting her withdrawals from her retirement accounts, we were able to lower her taxable income, and that helped her keep more of her Social Security benefits.
That's a great example of how proactive planning can really make a difference.
Exactly. And it's not just Nancy. Many pre-retirees are grappling with similar issues. They often think, I'll just rely on Social Security. But when they see how it fits into the larger tax picture, they realize they need a more comprehensive approach.
It's like a puzzle, isn't it? You can't just look at one piece in isolation without considering how it interacts with the others.
Well put. And with all the ongoing changes in Social Security, like potential adjustments to benefits or taxation thresholds, it's essential to stay informed.
Definitely. It feels like there's always something new to learn. And for those nearing retirement, time is of the essence. They need to make sure they're setting themselves up for success while there's still time to adjust their plans.
Right, and the emotional side of financial security in retirement can't be overstated. When you know you have a solid plan in place, it can really enhance your quality of life. You can enjoy your retirement without the constant worry about money.
So true. And for those who may not have thought much about this before, it's a good reminder to start thinking about their retirement income strategy now, before it's too late.
Exactly. It's about taking control of your financial future. So, the next step is to look at core strategies for managing Social Security taxation effectively, so that you can keep more of what you've earned.
I can't wait to dive into that. It's going to be super helpful for our listeners.
So, when we dive into the taxation of Social Security benefits, it's important to understand how your other income sources can impact that. You know, the IRS uses something called the combined income formula.
Right? Combined income? That sounds a bit complicated. Can you break that down for us?
Sure. Combined income is basically your adjusted gross income, plus any non-taxable interest you might have, plus half of your Social Security benefits. So let's say you have a $30,000 pension, $5,000 in interest, and $20,000 from Social Security.
Okay, got it. So that would be $30,000 plus $5,000 plus $10,000, right?
Exactly. So that totals $45,000. Now, depending on your filing status, this is where it gets interesting. For single filers, if your combined income exceeds $25,000, up to 50% of your Social Security could be taxable. If it goes over $34,000, it could be up to 85% taxable.
Wow, that's a pretty significant range. So if someone's income is close to that threshold, they really need to plan ahead, huh?
Absolutely. And if you're married filing jointly, those thresholds are a bit higher, $32,000 and $44,000 respectively. So it's crucial to keep an eye on your total income during retirement.
So how can someone optimize their Social Security to minimize taxes?
Great question. One strategy is to delay taking Social Security benefits if you can. The longer you wait, the higher your monthly benefit will be. Plus, if you're not drawing from it, your combined income remains lower, which could keep you below those tax thresholds.
That makes sense. So waiting could not only increase the benefit, but also help with tax implications.
Exactly. And consider your other income sources too. If you have a mix of taxable and non-taxable income, like Roth IRAs or municipal bonds, you can balance that to manage your tax bracket.
Roth IRAs, huh? They're tax-free in retirement, right?
Yes! Withdrawals from Roth IRAs don't count as income when calculating your combined income for Social Security. That's a big advantage.
So if someone had a good chunk in a Roth and wanted to keep their Social Security benefits tax-free, they could withdraw from that instead.
Precisely. It's about managing your cash flow strategically. And, it's always a good idea to have a diversified portfolio.
Right. Speaking of that, how should someone allocate their assets?
A common rule of thumb is the 70/30ths portfolio. 70% in stocks and 30% in bonds for growth, while still having some stability. But as you approach retirement, you might want to shift that, maybe to a 60/40ths, or even a 50/50 to reduce risk.
So adjust your asset allocation as you get closer to retirement.
Exactly. And don't forget about tax advantage accounts. You want to think about where your withdrawals are coming from. If you have a 401k or a traditional IRA, those distributions will be taxed as ordinary income.
So ideally, you'd want to withdraw from those accounts when you're in a lower tax bracket.
Yes, and that's where the bucket strategy can come in handy. With this, you create different buckets for different time frames: short-term, medium-term, and long-term.
Oh, I like that idea. So what would be in each bucket?
Good question. In the short-term bucket, you might keep cash or cash equivalents for immediate needs. Think a year or two of living expenses. Then, in the medium-term bucket, you might hold bonds or conservative investments. Finally, in the long-term bucket, you could invest more aggressively in stocks.
That sounds like a smart way to manage risk over time.
It really is. Plus, it helps you avoid having to sell investments in a down market, just to meet your expenses.
Yeah, nobody wants to do that. What about required minimum distributions, or RMDs? How do those fit in?
RMDs are critical. Once you hit 72, you'll need to start withdrawing a minimum amount from your traditional retirement accounts. This can push you into a higher tax bracket, which can complicate your overall income picture, impacting your Social Security taxation too.
So planning for those distributions is really important.
Definitely. You might want to consider taking some distributions earlier, especially if you're in a lower tax bracket before those RMDs kick in.
That's a good strategy. And what about real estate?
Real estate can be a great income source in retirement, but it's crucial to think about how it fits into your overall plan. Rental income is taxable, but if you sell your primary residence, you might qualify for that exclusion of up to $250,000 for single filers, or $500,000 for married couples.
That's a nice benefit.
It is, but it's all about timing and understanding how that income will affect your taxes in retirement.
This is a lot to think about.
It can feel overwhelming, but taking a strategic approach to your income sources, taxes, and withdrawal strategies can really help make your retirement more enjoyable.
Yeah, and avoiding pitfalls is key. What are some common mistakes people make in this area?
Well, one big pitfall is not accounting for taxes on Social Security benefits, which can lead to unexpected tax bills.
That sounds like a shocker for many retirees.
It is. Also, failing to diversify income sources can leave you vulnerable. Relying heavily on one source could spell trouble if that income stream changes.
So spreading out risks is essential.
Exactly, and not having a withdrawal strategy can be detrimental too. That's why planning ahead can make a huge difference.
It sure can.
So Emily, one common pitfall that we see with retirees is the sequence of returns risk. It's a big deal because it can really affect how long your money lasts, right?
Absolutely, David. I mean, if someone experiences a market downturn right when they start withdrawing from their retirement savings, that can really derail their plans, can it?
Exactly. We had a client, let's call him Tom, who retired right before the 2008 financial crisis. He was so excited to start traveling and enjoying life, but, the market took a significant hit shortly after he started withdrawing funds.
Oh no, that sounds rough. What happened to Tom?
Well, Tom was pulling out a fixed percentage of his portfolio every year. After the downturn, his account balance was much lower, and he was still taking out the same percentage, which meant he was withdrawing a lot more in terms of actual dollars than he had planned.
That's a tough lesson. So it really emphasizes the importance of having a strategy in place, doesn't it?
Yes, it does. Having a solid withdrawal strategy is crucial. You want to consider, the market conditions and adjust your withdrawals accordingly.
And that brings us to another mistake we often see: ignoring taxes in the withdrawal strategy. Many retirees don't account for how taxes can eat into their income.
Right, and that can really sneak up on people. For example, we had a couple, Jane and Mike, who were living comfortably on their retirement income. They had a mix of taxable accounts, tax-deferred accounts, and tax-free accounts like Roth IRAs.
Got it. So what did they overlook?
Well, they primarily withdrew from their taxable accounts without considering the tax implications. When it came time to file their taxes, they were hit with a hefty bill that they hadn't planned for, which cut into their spending money.
Yikes. That must have been a shock for them. How could they have avoided that?
They could have benefited from a more strategic approach, like withdrawing from their tax-advantaged accounts first, or balancing their withdrawals to minimize taxes each year. It's all about planning ahead.
Definitely. And then there's the issue of underestimating healthcare costs, which is a huge concern for many retirees.
Yes, and it's often underestimated. I remember a client, let's call her Linda. She thought she had enough set aside for healthcare, but as she aged, her medical needs increased, and so did her costs.
What kind of costs are we talking about?
Things like long-term care, out-of-pocket expenses, and even Medicare premiums. They can add up quickly. Linda found herself dipping into her savings much faster than she anticipated.
Wow, that's a real eye-opener. So what can retirees do to prepare for those unexpected healthcare expenses?
It's essential to do some research and consider options like long-term care insurance or setting aside a dedicated healthcare fund within their retirement savings. Planning for these expenses is just as important as planning for regular living expenses.
Absolutely. And then there's the issue of poor asset allocation. I feel like so many retirees just let their portfolio sit without reviewing them regularly.
You're right. I had a client, let's say her name is Sarah, who had a very conservative portfolio because, she was afraid of market volatility. But in doing so, she missed out on potential growth that could have helped her keep up with inflation.
That's a tough spot to be in. So what would you suggest for someone like Sarah?
It's important to regularly review your asset allocation to ensure it aligns with your risk tolerance and financial goals. A well-diversified portfolio can help manage risk while allowing for some growth.
Great advice. Another mistake I see people make is claiming Social Security too early. It's such a huge decision, but many jump the gun because they want the money now.
Exactly. I had a client, let's call him Mark, who claimed Social Security at age 62 because he wanted to retire early. He thought it was a great idea at the time, but he didn't realize that by doing so, he was reducing his benefits significantly for the rest of his life.
That's such a big decision to get wrong. So what should people consider before claiming?
They really should think about their health, life expectancy, and, whether they can afford to wait a bit longer. Sometimes, waiting even a few years can result in a much larger monthly benefit.
And that's a game changer for many retirees, isn't it?
Absolutely. It's all about maximizing those benefits. If they can afford to wait, it might be worth it in the long run.
So, David, what red flags should people be aware of when it comes to their retirement planning?
Well, first, if you're feeling constantly stressed about your finances, that's a red flag. You should have a plan in place that gives you peace of mind.
That makes total sense. What else?
If you find yourself having to dip into your savings more often than planned, or if you're unsure about how long your money will last, those are big warning signs.
And it sounds like regular check-ins with a financial advisor can really help keep you on track.
Yes, exactly. Regular reviews of your financial situation, your goals, and your strategies can help catch potential issues early on. It's all about being proactive.
Such great insights. So for anyone listening who might be worried about these pitfalls, what are some next steps they can take?
Start by doing a thorough review of your financial plan. Look at your withdrawal strategy, reassess your asset allocation, and consider your healthcare needs. And don't hesitate to reach out for professional guidance to help navigate these decisions.
Definitely. It's never too late to make adjustments and ensure you're on the right path.
Exactly. Taking proactive steps can make a huge difference in your retirement experience and help you feel more secure about your financial future.
Well said, David. There's so much to think about, but with the right approach, retirees can avoid these common pitfalls and enjoy their golden years.
Absolutely, Emily. It's all about being informed and prepared.
And that wraps up our discussion for today on Social Security taxation and common retirement pitfalls.
All right, Emily, let's dive into some immediate steps our listeners can take today to better understand and manage their Social Security taxation.
Absolutely. It can feel overwhelming, but breaking it down into actionable steps makes it so much more manageable.
Exactly. First off, I'd recommend visiting the Social Security Administration's website, ssa.gov. It's a treasure trove of information. You can create a My Social Security account there, which allows you to see your earnings history, get estimates of your future benefits, and understand how your benefits might be taxed.
That's a great start. And for those who might be a bit more hands-on with their finances, using retirement calculators can really help. Platforms like Vanguard, Fidelity, and Schwab offer fantastic retirement calculators. They can help you project your benefits and see how different income levels affect your taxes.
Right, and those calculators often allow you to input various scenarios, which is super useful. It helps you visualize the impact of different income streams. So if you're considering part-time work in retirement or have investment income, you can see how that plays into your tax situation.
And don't forget about tax software. Programs like TurboTax or H&R Block can guide you through the process of filing your taxes, especially when it comes to Social Security income. They have tools that explain how benefits are taxed and can help you calculate your taxable income.
Yes, a lot of people don't realize how important that is. Even if you're not filing just yet, getting familiar with how these platforms work can set you up for success.
For sure. And if you're looking for some additional resources, there are plenty of books and podcasts out there focused on retirement planning.
Absolutely. One book I often recommend is The Boglehead's Guide to Retirement Planning. It's straightforward and packed with practical advice.
Oh, I love that one. There are also some excellent podcasts like The Retirement Answer Man by Roger Whitney. He dives deep into retirement strategies and has a very engaging style.
That's a great suggestion. And speaking of podcasts, it's also a good idea to start reviewing your portfolio regularly. Set a habit of doing this quarterly. It helps keep you on track and ensures your investments align with your retirement goals.
Yes, consistency is key. And while you're at it, running retirement projections periodically can be a game changer. I mean, just a simple calculation can show you how your savings and expected Social Security benefits will work together.
Exactly. And remember, it's never too late to improve your plan. Whether you're just starting to think about retirement or you're already in it, small steps can make a significant difference.
Right. And talking about small steps, if you haven't yet, consider downloading a financial planning app. There are several user-friendly options available that can help you track your expenses, savings, and even your tax implications.
Great point. Apps can make financial management feel less daunting and more intuitive, especially for those who might not be as comfortable with traditional budgeting methods.
And don't forget to connect with a financial advisor if you feel you need personalized guidance. Having someone who understands your unique situation can provide clarity and help you make informed decisions.
Definitely. A good advisor will help you navigate the complexities of Social Security and taxes, ensuring you're making the most of your benefits.
So to sum it up, there are plenty of tools and resources at your fingertips. Whether it's using calculators, tax software, or simply setting up a routine to review your finances, every little bit counts.
Absolutely. With these tools in your pocket, you're ready to strengthen your retirement plan. Let's recap what we've covered today. Well, Emily, it's been quite a journey discussing Social Security taxation today.
Yeah, it really has. So let's quickly recap some of the key takeaways for our listeners. First off, understanding how your Social Security benefits can be taxed is crucial for planning your retirement income.
Exactly. And remember that not everyone will pay taxes on their benefits. It really depends on your combined income, which is something to keep in mind.
Right. And it's important to know that if you're in a situation where you do have to pay taxes on your benefits, the tax rate can be pretty manageable if you plan properly.
And don't forget about the importance of timing your benefits. Deciding when to start taking Social Security can have a big impact on your overall financial picture.
Absolutely, and planning for taxes on those benefits can help you avoid surprises later on. It's all about being proactive, right?
Yes, and as we wrap up, I just want to encourage everyone to take control of their retirement planning. Building and protecting your retirement wealth is a journey, and it's okay to seek help along the way.
So true. We're here to help you navigate those waters. And if you enjoyed today's episode, consider liking this video, subscribing to our channel, and, drop a comment below about your biggest takeaway or any questions you might have.
And don't forget to share this episode with someone you know who's planning for or already in retirement. It could really help them out.
Next time, we're going to dive into something that I think a lot of people are curious about. How to retire early with low expenses.
That's going to be a great discussion, Emily. I'm looking forward to it.
Me too. Thanks for joining us today, everyone.
Take care and happy planning.
Bye for now.